Today, we're diving into what some analysts claim could be one of the most significant financial events of our time, a historic revaluation of silver. We're going to look at the evidence that suggests a massive supply squeeze is happening right now for a metal that, and this is key, is absolutely essential to our modern world.
All right, so here's our game plan. We're going to start with a really strange anomaly that's catching a lot of eyes, a major run on the world's silver vaults. Then, we'll see how this might fit into a historical pattern that's played out before in commodity markets. From there, we'll get into the details of the supply squeeze happening today, connect it to the bigger picture of a potential global monetary reset, and finally, explore what the sources we've looked at believe the endgame, what they call Stage 4, could look like.
So where does this whole story really begin? Well, it starts with a series of really unusual events in the silver market. And according to the sources we've reviewed, these aren't just your typical market fluctuations. They're seen as major warning signs that something fundamental is changing.
The sheer scale of what's happening is what really stands out. One source highlighted this number: 37.6 million ounces of silver just gone from exchange vaults in less than 2 months. Now, to put that into perspective, that's a rate of withdrawal we haven't seen since 1980, the year silver's price famously went vertical. This suggests it's not just investors cashing out. This looks like a genuine run on the physical metal itself.
And this isn't happening in a vacuum. Look at the pattern that seems to be emerging around the globe. In early 2025, 4 big South Korean banks just stopped selling physical silver, period. Around the same time, China reportedly put restrictions on buying precious metals through its banks. Then you've got the CME suddenly halting trading because of a cooling failure, and JP Morgan getting hit with delivery demands for over 5 million ounces in a single month. You know, individually, these are just news stories, but when you put them all together, some analysts see a clear pattern pointing to one thing: a serious and growing scarcity of physical silver.
So this brings us to the absolute core question of this whole analysis. Why the sudden worldwide scramble for physical silver? I mean, we're not talking about paper contracts or ETFs here. We're talking about the real, tangible metal you can hold in your hand. What could these big institutions and major players be seeing that the rest of us aren't?
The sources we've analyzed suggest this isn't just random chaos. They point to a very predictable, 4-stage pattern that has shown up time and time again in past commodity crises. It's almost like a blueprint.
Okay, so here's how this historical playbook usually unfolds. It starts with Stage 1, the foundation. Everything seems fine, the commodity is stable, supply feels infinite. Then comes Stage 2, the distortion. This is where paper claims, think futures contracts, get created, and they start to vastly outnumber the actual physical stuff in the warehouses. Stage 3 is where it gets interesting, the choke point. This is when people start losing faith in those paper promises and begin demanding the real thing, which starts draining the inventories. And all of that sets the stage for the finale, Stage 4, the break. This is when the paper market simply can't deliver, it fails, and the price of the physical asset completely decouples from the paper price.
And if you want to see this pattern in action, there's no better case study than the most famous event in modern silver history, the Hunt brothers' attempt to corner the market back in 1980. It's a fascinating look at what happens when a tidal wave of physical demand crashes into a distorted paper market. The timeline here just shows how explosive this dynamic can be. The Hunt brothers started buying around $6 an ounce, but here's the key. Their strategy wasn't just to hold paper. They demanded physical delivery. That created a classic choke point, inventories got drained, and the price just went parabolic, soaring to almost $50. The whole system was right on the verge of breaking, and that's when the regulators had to step in, literally change the rules of the game overnight, and the paper price came crashing back down.
But here's the critical lesson from 1980. There were 2 completely different outcomes. The Hunts, who were leveraged to the hilt in the paper market, got completely wiped out when the rules changed. But regular investors who just held physical silver, with no leverage, no margin calls, they walked away with massive profits. It highlights this crucial distinction. Owning a promise on paper is not the same thing as owning the actual asset.
So, with that historical blueprint fresh in our minds, let's look at the evidence that suggests the silver market today might already be deep inside Stage 3, the choke point.
At the very heart of the issue is this unbelievable distortion. According to one analysis of the COMEX data, for every single ounce of physical silver that's actually available for delivery, there are 30 paper contracts all laying claim to it. It's like a game of musical chairs with 30 people and only one chair. The whole system works perfectly, as long as most people don't try to sit down at the same time.
And this is exactly why that ratio is so important. This chart shows that the actual registered inventory, that's the metal that's ready to be shipped out, has been dropping like a rock. The sources we've reviewed argue that this is, plain and simple, a run on the vaults, draining the physical buffer that lets the paper game continue.
The market is also flashing this really rare warning sign called backwardation. Now, normally, a promise to get something in the future is cheaper than getting it today, right? Well, with backwardation, that whole idea gets flipped on its head. It means people are willing to pay more to have physical silver right now than to wait for a future delivery. Analysts see this as a sign of outright desperation for the immediate physical product.
So what in the world is driving this drain? Well, the sources point to a perfect storm. You've got industrial companies panic buying to secure their supply chains, arbitrage traders grabbing cheaper metal on the West and selling it for more in Asia, and even miners who are starting to bypass the exchanges altogether. But maybe the biggest catalyst of all is something called Basel III. These are new international banking rules, and they're a potential game changer. They basically require banks to hold more physical metal to back their paper promises, which could be dismantling the whole fractional reserve system that's been in place for decades. And this chart really highlights why that physical demand is so relentless. See, unlike gold, which mostly just sits in a vault, silver actually gets consumed. It's an absolutely essential component in the world's fastest growing and most critical industries. Solar panels, electric vehicles, 5G tech, the entire green energy and technology revolution is literally built with silver.
And the demand from just one of these sectors is mind-boggling. According to the research cited here, the green energy transition is so silver-intensive that the solar industry alone could eat up the vast majority of the planet's known silver reserves in the coming decades. This isn't just speculative demand from investors, this is structural industrial demand that is baked into global policy for years to come.
Okay, so the analysts we've been reviewing argue that a squeeze in a relatively small market like silver isn't just happening in a vacuum. They see it as a symptom, a canary in the coal mine, if you will, for a much larger instability brewing in the entire global financial system.
And at the heart of that instability is this unprecedented explosion in government debt. Just look at these numbers for the U.S. national debt. It's not just growing, it's accelerating, adding trillions of dollars every single year. And that kind of growth creates a cascade of problems for central banks. This mountain of debt creates what some analysts call an impossible choice for the Federal Reserve, a trap. If they raise interest rates to fight inflation, the cost of paying interest on the debt could trigger a massive economic collapse. But if they cut rates and print more money to save the economy, they risk unleashing much, much higher inflation. According to this view, there are no good options left on the table.
And in response to all this instability, what are we seeing? Central banks around the world are preparing for a different kind of future. They're buying physical assets like gold and silver at a record pace. At the same time, major nations are building trade systems that don't rely on the US dollar. This whole trend, often called de-dollarization, represents a massive potential shift away from the financial system we've known for decades.
And this fits a pattern we've seen throughout history, for centuries. From ancient Rome debasing its coins to 20th century Britain losing its empire, the story is almost always the same. When confidence in a currency starts to fade, capital flees. It moves into tangible, hard assets that can't just be created out of thin air.
So, if we are in Stage 3, what do the sources predict Stage 4, the break, will actually look like? What is the potential endgame here?
This is the moment that whole four-stage pattern leads to. It's the point when physical demand completely overwhelms the paper market. When that happens, the paper price that you see on your screen could become totally disconnected from reality. A dislocation occurs, and the only price that matters anymore is what someone is willing to pay to get physical metal in their hand, right now.
The analyses we looked at lay out a few different scenarios for where the physical price could go. The most conservative one is based on the historical gold-to-silver price ratio. If that ratio just went back to its long-term average, it would imply a silver price somewhere in the range of $120 to $150 an ounce.
A second scenario takes that 1980 peak price of nearly $50 and simply adjusts it for all the inflation that's happened over the last 4 decades. Well, that calculation puts the equivalent price today well over $200, maybe even closer to $250.
And then there's what some call the vertical spike scenario. This could be triggered if those industrial users start to panic about their supply chains. Think about it. For a solar panel or an EV company, silver isn't an investment. It's an essential ingredient they can't build their products without. In that situation, if their multi-billion-dollar production lines are about to shut down, the price they're willing to pay for silver could become almost irrelevant. They just need to get it, potentially pushing prices to $350 or even higher.
So, the crucial takeaway here, and it really echoes that lesson from 1980, is the huge difference between a paper promise and a physical asset. In a true market break, a paper contract could be forcibly settled for cash at a price you don't like, or it might not be deliverable at all. Physical silver has no counterparty risk. That means you're not relying on anyone else to make good on a promise. You hold the actual asset, and its price is determined by real-world supply and demand. Simple as that.
This brings all these pieces together: the strange vault drains, the historical patterns, the industrial demand to supply squeeze, and it all leads us to one final question that really frames this entire analysis.
The sources we've examined lay out a pretty compelling case that what's happening in the silver market isn't just random noise, but a predictable outcome based on historical patterns and very real, current data. Ultimately, though, it leaves us with this fundamental question. Are we witnessing the logical conclusion of a 50-year experiment with paper currency, or is this all just the biggest speculative gamble in history? According to these analysts, the answer could have profound implications for the future of wealth.